The California housing market is completely unaffordable, and unfortunately, it's likely to get much worse before it gets any better, as we're starting to see interest rates move towards 7% once again in the face of disappointing CPI data on top of strong job numbers. In the fourth quarter of 2022, only 17% of California households could afford the median California home price of $790,000. And that's down from 25% in the fourth quarter of 2021. You would actually need a minimal annual income of just over $201,000 to make monthly payments of $5,080 per month. That would include principal, interest, taxes, and insurance on a 30-year fixed rate mortgage at 6.8%, which is more or less where we're sitting today for most well-qualified buyers out there. In addition, only 26%, 1 in 4 of Californians could afford the median price condo or townhome at $610,000. That's because they would need a minimal annual income of just over $155,000 to be able to make that mortgage payment of over $3,800 per month. And the problem doesn't stop here in California, as only 38% of the nation's households can afford the median home price of just over $378,000, which would require an annual income of over $96,000 to be able to make that payment of over $2,400 per month. And here's the crazy stat. Nationwide affordability was sitting at 51% just a year ago. So why have we seen this big change in affordability? Well, it has to do with home prices appreciating, but the biggest factor has to do with interest rates going up. A lot of buyers out there don't understand how much interest rates actually affect affordability. So with that said, I want you to take a look at this chart here. It's a chart that I pulled from a newsletter that I subscribe to locally called Reports on Housing, and it shows if somebody wanted a desired monthly payment of say $4,000 a month, what they could have gotten when interest rates were at 3.25% versus what they could have gotten when interest rates peaked above 7%. So back when interest rates were 3.25%, they could have gotten a property just over $1 million. Whereas interest rates are today sitting somewhere around 7%, you're looking at a home somewhere in the mid $600,000 range. That's nearly a $500,000 difference in purchase price. So what is the solution to more affordable housing? When are we going to see lower interest rates? When are we going to see lower house prices? What's actually happening with California real estate? What should you do as a buyer or seller? That's what we're going to dive into in today's video, on top of actually talking about what's happening in my market here in Orange County. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. It helps the YouTube algorithm, helps push it out to more people, helps me accomplish my goal of educating buyers and sellers. And if you feel so inclined, do me a favor and also hit that subscribe button. So in early November, we actually saw interest rates start to decline, and we actually saw them continue to move down sometime until mid-January. And with that, we actually saw buyer demand start to come back to the market. We saw home prices stabilize in many markets out there. In fact, many of the sellers that were reducing their prices were actually able to stop because this buyer demand was starting to come back to the market. It was almost as if there was a ton of buyers just sitting on the sidelines waiting for interest rates to come down to get back in the market. And as soon as they came down and we started to see interest rates in the mid 5% range, we saw this pickup in activity. And we actually saw a lot of buyers out there in multiple offer situations having to offer more than the asking prices. In fact, many of the media outlets out there were talking about a bottom in housing. In fact, I did a video on the bottom in housing. And what I said was I didn't think we had seen a bottom quite yet. And then all of a sudden we got CPI data that didn't come out as good as economists had expected. It was declining. It's showing that it's moderating, but it's not moderating nearly as fast as the market wanted to see. And that created volatility in the market on top of the job numbers out there actually reporting stronger than expected. You know, we actually saw unemployment move down to say 3.4%, which tells the Fed that there's an opportunity for them to continue to raise the Fed funds rate, to continue to hike rates, but also get the best of both worlds, have their cake and eat it too, if you will, and get a soft landing. And so shortly after that meeting, we saw more Fed officials start to come out and talk about additional rate hikes. The market did not like that. And with that, we saw interest rates start to climb. Now, because of interest rates starting to move back up towards 7%, we actually saw mortgage applications drop 13%, and they're sitting at the lowest levels that we've seen in a very, very long time. And that's primarily because of housing affordability, people just not being able to afford homes at these prices. And because we haven't seen home prices crash in many markets out there, we haven't seen a huge drop in prices, housing still remains very, very unaffordable. So what are we likely to see over the next couple of months? Well, if interest rates continue to stay high, now I'm a believer, I've said it in other videos, that I think we're going to see lower interest rates, especially as the CPI data reflects that inflation is coming down, which I think you're going to start to really see here over the next couple of months. But let's assume that doesn't happen. If that doesn't happen, that means interest rates are likely to stay high. That's going to impact the number of homes coming to the market. It's going to impact the number of transactions actually taking place. And lastly, it will impact home prices. It will continue to bring home prices down, especially if you have a seller that needs to sell their home for one reason or another, because there's just going to be less activity in the market. But if interest rates start to slowly moderate again, if you start to see interest rates move back down again, maybe towards that 5.5% number that they were at just a couple of weeks ago, then I think that provides that floor in housing, kind of like it did back then. But even then, I believe it's a shorter term bottom in the market, not because I believe home prices are going to crash, but just because you don't have inventory coming to the market. There's a lack of supply out there. Now, if you pay attention to the media and you just read the headlines, it looks like inventory is picking up everywhere. There's a flood of homes coming to the market. In fact, the latest data from the California Association of Realtors shows that the statewide unsold inventory index is nearly double from where it was a year ago, with inventory sitting at 3.6 months of supply. But then if you talk to agents like myself or other agents in other markets, all we're talking about is how there's a lack of available property, a lack of inventory to choose from. On top of that, inventory nationwide seems to be a major problem. If you look at this chart here, you can see that inventory has continued to move down week over week and is currently sitting at just over 436,000 homes. That's nationwide, guys. That's including townhomes, condos, single-family homes across 50 states. So there's not a lot of available property out there to choose from, which is one reason that you're seeing house prices remain stable, because there's not a lot of supply coming to the market. And if interest rates continue to move up, and there is a chance they do it in the short run, unless we see better than expected PCE or CPI data, but because there's that lack of inventory, you're not going to see a huge drop in prices. But at the same time, even if interest rates pulled back, you're not going to see home prices move up a considerable amount either, just because there's not a lot of transactions actually taking place because of that lack of supply, because housing affordability is likely to remain a problem. Interest rates aren't going to drop so much that it creates this big spur in affordability. So the next few months with regards to California housing data is going to be interesting, because you don't have a lot of supply, you have a drop in buyer demand, and you have a volatile interest rate market, which is creating additional issues. But with that said, we actually saw the January statewide median home price drop 3% here in California to $751,000. And I think there's a chance if interest rates stay high, you're likely to continue to see that median home price drop a little bit, especially when they're comparing it year over year, just because home prices were going bananas in the first quarter of last year, and this year is going to be a much slower market. In addition, we've actually seen the days on market move up to 33 days from 12 days just a year ago. But at the same time, remember, it's a slower time in the market seasonally. This is typically a time when less transactions are taking place. So understand, just because a home is sitting on the market longer doesn't necessarily mean it's overpriced, doesn't necessarily mean there's something wrong with it. It could just be the time of year. And if you're out there buying a house, you're likely already aware of this, but the statewide sales price to list ratio sitting somewhere around 96.5%, whereas a year ago it was sitting just over 101%. And basically what that means is many buyers out there are getting homes for a few percent less than the asking price, whereas last year they were paying over the asking price. And I believe if interest rates move up, that number is going to go down. Whereas if we see a drop in interest rates, or interest rates stabilize, if you will, and stop seeing this crazy volatility in the market, then you're likely to see that sales to list price ratio stabilize as well. So what is actually happening in Southern California, my market here in Orange County? Inventory continues to be the problem. Continues to be the main driver of what's happening here. At the time I'm filming this video, there's only 2,269 active homes on the market. That's including single family homes, townhomes, and condos. And that might seem like a lot of homes to some people, but understand we're a county of 3.3 million people. On top of that, the 3-year average from 2017 to 2019 would have us sitting somewhere around 4,800 homes on the market during this time of year, which is nearly double from where we are today. And because we don't have a lot of supply out there, and we saw that recent drop in interest rates, we actually saw the days on market go down from 56 days on market to 45 days because all of these buyers got off the fence, took advantage of the rates, which caused a lot of those properties that were coming to the market to go under contract, leaving us with pretty dismal levels where we sit today. But because of that lack of inventory, we almost have a flooring in the housing market. Not to say that prices can't move lower, because they definitely can. But in order for homes to move lower quickly, to crash, if you will, you need a flood of homes coming to the market. You need distressed sales. You need people that have to sell. And because many homeowners out there are sitting on super low interest rates, there's no stress for them to sell their property. There's no stress for them to need to do something, because not only are they sitting on a super low rate, they're likely sitting on a ton of equity as well. Now, earlier I mentioned we're not seeing new listings. We have seen new listings come to the market here in Southern California and Orange County. We saw 1,680 new listings come to the market, but that's compared to the 3-year average, again, between 2017 and 2019 of just over 3,000 homes. So we have almost half the amount of homes coming to the market right now as we would have just a couple of years ago. In fact, here's a market breakdown on Orange County from, again, Reports on Housing that shows different price points, the days on the market, and how quickly things are moving. So what should you expect as a buyer or seller out there in the market at the moment here in California? Well, I believe if you're a buyer out there, there's not really a huge rush to go out and buy a property unless you can find the right home, the payment makes sense to you. I've heard a lot of buyers out there talking about, I'm not buying until interest rates go back into the 3-4% range. I don't know that that's likely to happen. So if you're a buyer waiting on that, then you're probably not a buyer at all. So it's more about finding the right property, being able to afford the monthly payment, having money in the bank, and more importantly, having a long-term time horizon. Because we saw so much appreciation in such a short period of time, there's a very good chance that home prices don't appreciate like we've seen in the past and more or less move sideways for a couple of years. So having that longer-term time horizon protects you against any fluctuations in the market. Now, with that said, what do you do if you're a seller? Should you be selling your property right now? Honestly, that's a tough question. Typically, this would be the best time of year to sell your home. And I still believe that. Even though interest rates have moved up a bit, I believe that the spring market is the best time to get the most amount of money for your home. But at the same time, unless you have to sell your home, unless you're actively looking at the market and see something that you want to move into, then it's going to be tough out there. So I think if you're a seller this year, if your goal is to sell your home this year, the first quarter, the first half of the year is when you probably want to put it on the market. Whereas if you're someone that doesn't necessarily have to sell this year, you're just kind of thinking about it, then I would almost suggest that you stay put, especially if you have a low interest rate. Why give up that property? Stay in that property for as long as you can. Now, I know that's a crazy thing to hear from a real estate agent telling a seller not to sell a property, but I just think that there's going to be a lack of options out there to trade up into if you're a seller. So with that, if you're a buyer, seller out there thinking about doing something, wanting to have a conversation with an expert, with somebody that understands the market, do me a favor. My contact information is listed below. Reach out to me. Happy to have that conversation. But if you're one of those people out there thinking the housing market is going to crash, it's absolutely going to crash, well, here's a video where I describe why it's not in detail. So do me a favor and check that out.